That up just a little bit, Alfie. Lay down, Sally. Woo!
Lay down, Sally.
I love it. Eric Clapton, right here on 640 WGST.
Look at me, you sound like a DJ there for a second. That was pretty sweet. You see that? Look at that.
So I have a career. Can I switch over to Power 96?
Yeah, I was about to say, I'll put it together on an audition table, send it over to Power. And
I'm pretty sure if I agreed to do the show for free, they'd let me try it.
I think they would. I think they would.
You're listening to the Call Cleve Atlanta Real Estate Show right here on Talk Radio 640 WGST, where we are featuring the music of Eric Clapton, which is actually a favorite of mine and of Alfie's. We both love Eric Clapton. We appreciate you sticking with us through the break. If you need to reach us, the number is 770-497-0000. Darian in Johns Creek has a question. How does a mortgage work? And I think specifically her question was, how does it work when you pay it off in 15 versus 30 years? Mortgages in today's market, there are actually some companies that will give you a mortgage and amortize it over any number of years that you wish. That is not the most common way to do it. The most common way to do it is to have mortgages that are amortized over 15, 20, or 30 years. And Darian, the way it works is simple. If you have a mortgage, which we call them mortgages in Georgia, although we don't actually use what is called a mortgage, we use a security deed. We'll talk about the difference in that in just a second. But if you're going to pay it off over 30 years and you borrowed $200,000, then you pay one slice of that $200,000 back in terms of principal payments. You pay one slice of that back every single month. So if you amortize a loan over 30 years, then you're going to pay the principal balance off in 360 payments. If you amortize it over 15 years, you're going to pay the principal balance off in 180 payments. So your principal portion of the payment is going to be much higher with a 15-year loan than it is with a 30-year loan. And the reason, Darian, you have to start over when you refinance is that most companies, let's say you got a 30-year mortgage to begin with, you paid on it for 5 years, which means you only have 25 years left. Most companies only offer a 15, 20, or 30-year amortization. If you don't want your payment to go sky high, then most people tend to choose the 30-year amortization, which means you're basically starting all over again. Had a conversation last night, as a matter of fact, with a seller and a buyer, someone we're working with out in the Winder area that's going to be moving to the Duluth area. And he has always wanted to have a 15-year mortgage, Alfie, but he's always had a 30-year mortgage. And I said to him, well, why don't you just turn your 30-year mortgage into a 15-year mortgage? And he said, well, how do I do that? I said, well, you just make payments as if you were going to pay it off in 15 years versus 30 years. And he did not have any idea that he could do that. And I said, ultimately, and this is not accurate, but if he added one more payment per year, so let's say his payment was $1,000 a month, and he added one more $1,000 payment per year, he could either pay, $88 a month, or $83 a month, or whatever, or just make one more payment every year. Then ultimately, he would pay that loan off 6 or 7 years earlier than if he did not make those additional principal payments. So if you have a loan and you want to know basically what you need to pay in order to amortize it over 15 years versus 30, you can certainly call your servicer or the company you receive your monthly mortgage statement from, or if you want, give us a call, 770-497-0000, and we can run an amortization table for you and help you understand how much you need to pay. And Alfie, it's interesting, if you paid an extra $100 a month, would you and your new wife miss $100 a month?
No, not at all.
But think about that over time. What if you had an additional $5,000, $10,000, $20,000 worth of equity in your home because you're making those additional principal payments? You'd be rich, and you wouldn't even know it.
Right.
And that's the key.
And you get out of that loan quicker.
Exactly. Next, I wanted to talk about the principal, interest, taxes, and insurance payment. And this is assuming 20% down in each one of these scenarios. You can also, you can pay as little as 2 or 3% down. Actually, there are 0 down payment programs that are available out there. But this is for 30-year amortizations, 1% property taxes, and about $1,000 a year for insurance. But Alfie, the payment on a $150,000 home purchase would be $856 a month, which I'm guessing, Alfie, is significantly less than the payment would be, or the rent payment on an apartment in that same area. At a $200,000 purchase price, the payment would be $991. At $250,000, the payment would be $1,213 per month. At a $300,000 purchase price, the payment would be $1,453. At a $350,000 purchase, the payment would be $1,680 per month, and at a $400,000 purchase, and the loan limit for conventional loans is $417,000. That's why we stopped our examples at $400,000, but the payment would be $1,899. And if you went to rent that same $400,000 home, your rent payment would probably be closer to $2,500 to $3,000 per month. So there is a huge savings when it comes to buying a home. And with interest rates being so low today, the nice thing is, Alfie, is when you lock in your interest rate today on a 30-year loan, it doesn't change for 30 years. So if you locked it in at 3.75 or 3.875% or 4%, it would stay that way for a full 30 years or 15 years or 20 years,
Amazing.
however long you finance it. Let's move.